Welcome back to EconExplorers TV, everyone. Today, we've got an intriguing subject to explore, the Federal Reserve. Now, you might be thinking, the Federal Reserve, isn't that just a bunch of bankers and financial mumbo-jumbo? Well, hold on because we're about to reveal some captivating insights. Let's begin with the basics. The Federal Reserve, often simply called the Fed, is the central banking system of the United States. Its main role is to ensure a stable and robust financial system while fostering economic growth. The Fed was established in 1913 as a response to a series of financial crises that had troubled the country. Its creation aimed to provide economic stability, prevent bank failures, and control inflation. Here's where it gets really interesting. The Federal Reserve functions through a complex network of banks, which includes 12 regional Federal Reserve banks spread across the nation. These banks are tasked with implementing monetary policy in their respective regions. To achieve its goals, the Fed uses three primary tools: open market operations, the discount rate, and reserve requirements. Open market operations involve buying and selling government securities to regulate the money supply. The discount rate is the interest rate at which banks can borrow funds from the Federal Reserve. Reserve requirements are the minimum amount of funds banks must hold in reserve, set by the Federal. If a bank is short one night, it will borrow money from another bank to meet the requirement. By influencing this interbank rate, the Fed also affects other short-term rates. Here's how it works. Banks make money by borrowing at one rate and lending at a higher rate. If the Fed raises the federal funds rate, the borrowing cost for banks increases, leading them to raise the rates they charge their customers. This way, an increase in the federal funds rate can ripple through other short-term rates, affecting the broader U.S. economy. For example, if the economy shows signs of slowing, the Federal Reserve might lower short-term rates to stimulate growth. Consequently, banks reduce the rates they charge their customers, making it cheaper to borrow and less attractive to save. This leads to increased spending, borrowing, and investing, which the Fed hopes will spur economic expansion. Adjusting interest rates isn't as simple as turning a dial. To steer the federal funds rate toward its target, the Fed uses open market operations. This involves buying and selling government securities to influence supply and demand, thereby adjusting the federal funds rate. When the Fed buys securities, it aims to lower interest rates, increase the money supply, and encourage more lending to consumers and businesses. This process, known as quantitative easing (QE), is used to stimulate economic activity during financial crises and keep credit flowing. The Fed employed QE after the 2008 to 2009 financial crisis and again in 2020 in response to the economic shutdown. QE works by increasing liquidity in financial markets and reducing long-term interest rates. However, economists warn that excessive QE can be detrimental. The findings suggest that quantitative easing has a stronger inflation effect than conventional monetary policy. The Fed's objective is to keep two key economic indicators in check: unemployment and inflation. For instance, by lowering long-term rates, the Fed can help reduce rates on mortgages and other loans, potentially leading to more home purchases or business expansions. These new ventures result in more hiring and, consequently, higher employment. The Fed's primary focus is the federal funds rate, the rate at which banks lend to each other. An interesting fact about the Federal Reserve is that it operates independently from the government to ensure that monetary policy decisions are based on economic conditions rather than political pressure. By controlling the money supply, the Fed can influence both interest rates and the overall health of the economy. The Federal Reserve also plays a crucial role in promoting financial literacy and consumer protection. It ensures that banks operate fairly and transparently, safeguarding consumer rights and interests. So there you have it, folks, a peek into the world of the Federal Reserve. I hope you found this information as fascinating as I did. If you want to learn more about the Federal Reserve or have any questions, leave them in the comments below. And don't forget to hit that subscribe button and ring the notification bell for more exciting content. Until next time, stay curious and keep on learning.